Is Peloton an example that we're now past the peak for this cycle? Not only have we had a WeWork pulled, we've got a Peloton listing and falling significantly.
Yeah, there's kind of the great reckoning in the public markets of these private companies, these unicorns, and I think in the private market you see software is eating the world, and what's happened is that has been stretched as the natural things that have been disrupted, like Salesforce disrupting software for salespeople. Now it's migrating further and further afield. So you're seeing it come to commercial real estate. You're seeing it come to fitness. And what the key thing that we think about is some of these models have lower gross margins attached to them. So, and in the private markets, they were trading like software companies. But if you look at some of these companies that have much lower gross margins and are just very different businesses, and I think the public markets are voting on this, and they're saying, hey, this doesn't necessarily get a software multiple just because you're re-envisioning something.
I mean, that's interesting because we've seen that from other analysis as well. So gross margin, very binary. Above 50%, you can still spin with this, but below 50%, you can't. Is that kind of what you're saying?
Yeah, Fred Wilson had a post on this. He talked about Zoom 81%, Cloudflare 77%, Datadog 75%, and then some of the ones that have had tougher times: Uber 46%, Lyft 39%, Peloton 42%. So there's kind of a bifurcation of these companies. Zoom that's doing very well. It's a high margin, repeatable, sticky software business. In our portfolio, we have Icertis, WorkFusion. These are companies that are doing super, but they're more traditional enterprise software companies. I think as you get further afield from them, it's not that they aren't great companies. It's just I think people are looking at the valuations in the last private market valuations, and they're asking the hard questions, which I think is healthy. It doesn't mean they're necessarily completely bad businesses. I think Peloton's a very interesting company, but does it demand a software multiple?
So, John, what you said, which I agree with,
yeah.
Is obvious, and now we've had multiple examples of this happening. Why isn't it taken into account before the IPO pricing? Why don't the investment bankers have a frank discussion? Why do we have to wait till the IPO does really badly and then start talking about it?
Obviously there's momentum. People want to price at a healthy valuation. And there's fearsome competition amongst the top investment banks to get these listings. There's a further debate around direct listings. I'm a big proponent of direct listings. I think it's a healthier way. The kind of giving handouts to your friends from investment banks versus having an algorithm decide who gets the allocation. There's no lockup, so there's no headache over like, hey, when this lockup comes up, everyone's going to sell. Everyone can sell immediately. I think it's a healthier way to do it. I think that'll find pricing more quickly. But it's a good question. Like, why is a stock down 25, 30% in one day of trading? Like, it feels like there's a better mechanism for price discovery.